Investing becomes simple when you follow a structured plan. Most beginners feel overwhelmed because they start without direction. They try to pick stocks, react to headlines, or chase fast returns. But long-term investing is not about reacting. It is about building a system that works regardless of market noise. The first step is financial stability. Before investing, eliminate high-interest debt. If you are paying 20% interest on credit cards, investing in the market rarely makes sense. Paying off the debt gives you a guaranteed return with zero risk. Next, build an emergency fund. Save at least 3 to 6 months of essential expenses. This protects you from selling investments during job loss or unexpected emergencies. Without emergency savings, even a small crisis can force bad financial decisions. Finally, understand your monthly cash flow. Know how much you earn, how much you spend, and how much remains available for investing. Clarity creates control. And control builds confidence. Step 2 is defining your investment goal. Ask yourself clearly, why am I investing? If you are investing for retirement 30 years away, short-term market drops are far less important. Time reduces risk because markets historically recover and grow over long periods. If your goal is closer, such as buying a home in 5 years, your strategy must be more conservative. Capital preservation becomes more important than aggressive growth. Clear goals reduce emotional reactions. Without a goal, every market decline feels dangerous. With a goal, volatility feels temporary. Step 3 is deciding how much to invest. Start with a simple rule. Invest 10% of your monthly income. If your income grows, gradually increase it to 15 or 20%. For example, if you earn $3,000 per month, 10% means $300 invested monthly. That amount may look small, but consistency builds momentum. Compounding works quietly over time. Discipline matters more than trying to time the market. Step 4 is choosing a simple investment strategy. Many beginners believe they must find winning stocks. This creates stress and unnecessary risk. Instead, begin with diversified index funds. An index fund spreads your money across many companies, reducing the impact of any single failure. A simple allocation could be 70 to 80% in a broad market index fund and 20 to 30% in bonds or conservative assets. This balance allows growth while reducing extreme volatility. Step 5 is automation and patience. Set up automatic monthly contributions. Automation removes emotion from investing. You invest whether markets are rising or falling. Markets will go up. Markets will go down. Temporary declines are normal. The biggest mistake beginners make is panic selling during fear. Time in the market is more powerful than predicting short-term movements. Wealth building is steady. It is disciplined. It is patient. When you follow this 5-step structure, investing becomes manageable. And over time, consistency produces results.